Well, welcome, friends, to our weekly High Rock video. If you're watching for the first time and wish to learn more about High Rock, please check out our website at highrockcapital.ca. I am Scott Tomlinson, and with me is my partner and colleague and the founder of High Rock, Paul Tepsich. Today we're going to talk about our three asset models and any updates or developments in and around our tactical strategies. We'll talk about a little bit about what we see happening in the global economy and financial markets and other issues that we think are important in the world of wealth management. So, Paul, at the moment, any updates on our tactical or fixed income strategies?
No, we haven't really done any trades over the past week since our last call in any of our models, to be honest. Within tactical, we've had, well, actually, first I'll start with fixed income. Interest rates have largely stabilized and moderated their move. They had a pretty rough go. That being government bond prices went down, yields went up fairly substantially about a month ago or so. They seem to have moderated and stabilized, as I said. Global equity, obviously, we haven't done much there, and in tactical, we haven't done any worthwhile trades over the past. Or not worthwhile. We haven't done any trades over the past week. We had a few positions improve and one that's just slightly more negative as of the course of the day. So no changes.
All right. Let's talk a little bit about our global equity positioning. I mean, we're still holding a fair bit of what we classify as cash and equivalent in client and our portfolios. Still with an eye to the risk factors that are out there. We know that volatility has come down significantly from that March, April kind of period. But we don't think it's necessarily the end of volatility to speak of. I don't think we're going back into some of those lower levels of volatility that we had back in 2017, but I think we are keeping certainly our eyes open and watching, and you know we've seen a lot of the headlines focused on the Trump-Kim summit and as well as all the G7 issues, but you know a lot of that and very quickly gets built into what we'll classify as the current pricing situation, both in fixed income assets and in equity assets. Our job and what we try to do each and every day, and feel free to chime in at any time, but we want to be aware of what might not be built in to the current pricing. If there are potential surprises lurking behind the headlines. And based on that, we have to make sure that we're protecting our collective portfolios as best as we can from the risks of potential adverse market moves. Anything you want to add?
That's absolutely true. Absolutely true, and easier said than done, and requires a lot of due diligence and research and work, both at the macro or high level and at the micro or individually company level.
Yeah. And a lot of what you do is, well, you do both as well. I look after a lot of the macro stuff, but you do a great deal of in-depth research on some of the companies that you know reasonably well and have an eye on in our tactical portfolios.
Yeah, and within fixed income as well, within the corporate bonds that we own and preferred shares, for sure.
Absolutely.
So we're going to speak about global debt by the looks of it.
Well, it's something.
What's going on here?
It's something that we've touched on from time to time, and back in April, the International Monetary Fund put out this recent update, which shows how global debt continues to grow. And what I thought we'd touch on a little bit today is just what we think of that circumstance. I mean, that's something that is pretty significant, because 164 trillion, which is the equivalent of 225% of global GDP, is a significant new high in global debt levels. And again, it compares with the peak back in 2009, but it is now 12% of GDP. The world is now 12% of GDP deeper in debt, and then that's something that is not necessarily part of the headlines, but where it has some of its potential impact is in emerging market economies, and we've seen a couple of emerging market economies, such as Turkey and Argentina, recently starting to enter into the headlines. And I'm wondering if you had any thoughts there.
Well, those markets have had a pretty rough go as of late, and a lot of it is being driven by a slightly stronger U.S. dollar as well, and higher rates have all punished the emerging markets economies. But I guess one thing to keep in mind is right now we're looking at effectively structural debt, and two things we know, one is governments can afford, most levels of government, not municipal, but or state in the U.S., but most levels of sovereign government can afford to run large deficits and debt because they have taxing power. Privately, however, it's a different story because we as individuals and even corporations don't have that luxury of being able to tax. So we've got to, as individuals, we've got to make more income to pay down debt and service debt. And as companies, they have to do the same thing. They have to increase revenues and efficiencies and cash flow to try to delever and pay down debt.
And one of the things,
some of those.
Sorry.
Go on.
And one of the things the IMF pointed out that's clearly something that we have to always be keeping our eyes on is that, you know, it's great as long as growth is continuing. So as you said, governments can tax growth, and corporations, as long as they're growing, they can continue to pay down some of that debt if they can, or at least cover the interest on the debt. And again, private households, as long as they're employed, they can continue to pay the interest and hopefully some of the principal on the debt that they own. But when a financial situation occurs, or even a recession occurs, and some of those, so that earning power of households and corporations is mitigated, then we're going to have some potential problems, and that means that you will get the potential for a fairly abrupt deleveraging process, which was something we certainly experienced back in 2008. And given the current levels of debt, if the economies do start to slow or turn down, then there is the potential that that weaker fiscal position will increase the potential for the depth and duration of any recession. So these are the things that we want to be careful of, and we talk about where we might be relative to a recession. I talk about it when I'm talking to our clients in person about our views when we have our reviews. We talk about the fact that we think that the economies, U.S., Canadian, even the global economy, is probably somewhere in the latter stages of the cycle. I think it's probably, in baseball terminology, somewhere in the 10th inning or so. But we do have to always be careful about what's out and around the corner, especially with debt levels being as high as they are. So just something that we've talked about in the past. We haven't talked about it recently, but I thought I'd just touch base on it a little bit today, because it is always in the back of our minds.
Well, one thing I would add too, Scott, is it doesn't even have to be as draconian as a financial crisis because of the amount of leverage or debt in the system. But just think about individuals, corporations, and governments. If your debt is so high, say at the household level, so much of your take-home income or net income goes towards servicing the debt that you can't afford to go out and consume the way you used to consume when you didn't have the debt or as much debt. So therefore, and that happens at the individual or household level, corporate level, and certainly government level, that you get slower growth. So our listeners have probably heard the term 10 years ago, new normal. We're in a new normal period of slower growth, largely because of the amount of structural debt in the world that really clamps down on potential for higher growth, because it goes towards servicing that debt.
Right. And then we have the next additional issue to add to that. As you say, getting the debt service becomes an issue, but we know that we've seen inflation popping up, especially in the United States. And we saw news today about the latest inflation numbers from the Bureau of Labor Statistics. But we also know that tomorrow the U.S. Federal Reserve meets. We're fully expecting to see the U.S. Fed funds rate up another 0.25% to 2%. And that becomes a factor for debt servicing, and not just for U.S. households and U.S. corporations, but for some of those emerging and developing economies that have their debt denominated in U.S. dollars. And it becomes a double whammy when you have U.S. rates rising as well as the U.S. dollar rising at the same time. And that just means that those debt burdens are growing in relation to their home currency, the debt levels of their home currency, right?
Yeah, absolutely.
Anyway, that's basically all we're going to talk about today. Just something that we are keeping an eye on, something that's not necessarily in the headlines. That's kind of what we call page 10 or even further down the road, but something that does concern us and a reason why we continue to apply caution, especially in our global equity positions. And that's it for this week. Thanks for taking the time to tune in. We certainly appreciate your feedback and want you all to feel free to send in your questions at any time via email or in any communications that you wish to have. But we'll be back next week with another edition. And until then, we hope you have a great rest of the week and a wonderful weekend. And I am going to be in Calgary tomorrow and Vancouver for a few days after that. And I'm very much looking forward to seeing all our Western clients. So that's it. Have a great rest of the week.